Good evening, everybody. Joishtet, as they say locally. This is the third in the series of Danube panels entitled Unknown Knowns, Adventures in the New Economics, which hopefully will be running for the rest of the year, where we'll be talking about economics and economic adjacent topics, political economy, you might say. Tonight we have with us David P. Goldman, who's the deputy editor of Asia Times and Washington Fellow of the Claremont Institute, and also at the Corvinus Collegium here in Budapest, fellow, I think, I can't remember the exact title. And Theo MacDonald, who's a journalist from Ireland, who's written a report for the Irish Parliament, which is called the Dáil there, on this issue of private equity. I might have mislabeled the title a little bit. This is not just about private equity as an asset class, although anyone interested in that will probably learn something. But it's also about how the private equity industry overlaps with the housing investment and property prices, property ownership, and so on. So sadly, we probably should have advertised this better to pull in everybody who wondered if their house in Hungary was overvalued or not, but all the lucky people in the audience get free investment advice in that regard, so congratulations. I usually do a short presentation at the start of the topic to kind of introduce it, and then we turn it over to the panel, and then we go to Q&A. David Goldman's actually been generous enough to put together a very comprehensive presentation on the Hungarian property market, which is, I think, breaking news, David. I don't think this analysis has been done before, so once again, the people who took an interest. This is a debut of cutting-edge analysis of the Hungarian property market. So, lucky you, you're going to make an absolute fortune in the next 2 years. I'm kidding. So I'll give my quick presentation. I'll turn it over to David, and then we'll turn over to a panel. We may not have as much time for questions due to this slightly unusual structure, but we'll see. We'll see where the conversation goes. And it's a slightly small audience anyway, so I don't think that'll be a problem. So what is private equity? You've probably heard the name. Anytime you go to kind of a fancy dinner and there's a guy there with a Rolex, he'll be talking about private equity probably. Private equity is an asset class that mainly came about in the 1990s, and I mean, at a simple level, it differs from public equity, which is the stocks that you can buy on the market on your iPhone these days, in that you can't just publicly get access to it and trade it. You have to know people who know people. You have to become a limited partner, usually in a private equity firm, and put your money in. And then private equity firm goes around the world or around the country or wherever it is, and they buy things. They buy companies usually, but they can also buy other things, which we might get into. But private equity was set up so that they'd buy companies, and they'd take those companies private, as they say, as in they're not publicly traded. And then they'd be run on the basis of their private limited partner investors. So private equity has an air of exclusivity about it, although I think that's diminished over time. That's in theory anyway. In practice, there's been some criticism of the sector. I'm making no value judgments here. I think it's a mixed bag personally, although we can get into it. Some people have accused private equity of engaging in asset stripping sometimes. So this is a famous recent case of an American chain called Red Lobster, which served seafood all over the United States, a massive company that was very popular and, loomed large in the American public imagination. It was bought over by private equity. Short story is, private equity sold off a load of this property. It was seafront property. You've probably seen these in New England or something. It was seafront property, so the property was worth a lot of money on paper, So sell off all the property, even though this was like a pretty successful company. Oh, you've lost all your seafront property. But selling off the seafront property made sense if you're trying to extract returns from the business, you see. And so private equity can sometimes devolve into asset stripping. It doesn't always. And so people on the left may say, private equity is all about asset stripping. Sometimes. Sometimes it is. Sometimes it runs good companies, maybe. I don't know. But there has been accusations of this. So just quickly, before we get into the property aspect of it, this private equity thing is kind of an exclusive club, right? You'll be approached at a fancy dinner, guy with a Rolex, if you're willing to invest over some enormous amount of money, 100K or $1 million or something like that, you can become a limited partner. In theory, then, it should return very high returns, and of course, this is what the advertisement is. This is, you get access to an exclusive private equity product, and one study in American Affairs by Dan Rasmussen a few years ago showed that between 1990 and 2010, you got 14.4% on private equity, and if you'd invested that in the stock market in the S&P 500, you'd have got 8%. So you got almost double returns. I mean, so, that's why it's an exclusive club, I suppose. There's reason to think that may have been due to the fact that, as this chart shows, this isn't going to turn into a boring finance lecture, don't worry, but that chart shows basically that private equity was a lot cheaper back in the late 90s, early 2000s than the public equities markets. So the public equities markets were overbought, too many people were invested in them. And so you could hive off some money into private equity and they'd find these cheap companies. But as you see from about 2009 there, the valuations are now the same as public markets. It's become a bit overcrowded, would be my interpretation. So this is a classic instance of past returns are not indicative of future returns. Those 14.4% net returns you might have seen up until 2010 may have been from like the best period, private equity had ever seen. So it might not be all it's cracked up to be anymore. So as these multiples contract, sorry to use the financialese, but as these multiples contract and private equity as a sector grows, private equity is enormous now. I probably should have put the size, but it's very, very large in terms of how much capital it allocates. But where does it go? So, I mean, there's only so many Red Lobster chains you can buy up, right? So as over time, private equity's increasingly penetrated deeper and deeper into really all countries. America's got it particularly aggressively. Private equity's huge in America. It's pretty big in Europe too. And so it's gone down to the level now where they'll buy up kind of small companies, software companies, for example. A friend of mine does software companies. And they'll try and stitch these tiny little bespoke software companies together. Minor insurance brokerages is a big thing, like really small insurance brokerages in Ireland are being bought up by private equity companies. So as the money pot grows, the amount of stuff you have to distribute it to, you need more, right? You need more places to allocate your capital. Well, this chart shows... this isn't private equity investors, we don't have data on that, but this chart shows the percentage of homes in the United States that are being bought up by investors. That is, these are not being bought up by people who want to live in them, and I don't think you could even say these are holiday homes. These are bought by investors for investment purposes, so buying to either speculate on future price gain or to rent out. And as you can see there, in the early 2000s, it was about 7% or something, and it's gone up to about 18% in the US. That's nearly 3 times. So a significant, nearly a fifth of the US housing market is being bought up by investors. Now, a lot of this is private equity, in my opinion. We can't get the data because it's private. It's the secret club, so we don't know how much money is flowing anywhere. Private equity is sometimes called shadow banking. You might be familiar with it. It's adjacent to that. So we don't know how much is private equity, but probably a lot. At the same time, mortgage application volumes have plunged. You see there in the middle of that chart is around where the housing boom was in America. And as everybody now knows, the housing boom and bust in America was driven by mortgage lending, by the banks. These were the dodgy loans and so on. And since then, mortgage lending's fallen off a cliff. We had a brief spike just after the pandemic when there was a decline in house prices, but since then mortgage applications have gone down. And yet I don't have the chart up here, but as everybody probably knows, house prices have pretty much gone up and up. So what's driving the house market if not mortgage lending? Well, maybe private equity has partially replaced this, and maybe what's actually going on there is that regulations were put in place after 2008 which ensured that the housing market would never have this big bubble again, because people couldn't take out these no income, no asset, no job, ninja loans, or whatever they call them. They couldn't take out subprime mortgages, in effect, because the regulatory apparatus shut that off. Well, there are more than one ways to skin a cat. Just because the banks can't lend doesn't mean that private equity, hedge funds, etc. can't lend in different ways. It's a slightly different structure, but it may have a similar outcome. And so the banks have been watching this metric and making sure that we don't see crazy mortgage growth, and this private equity industry has grown up around. There's been whispers about it in the past 4 or 5 years, but no one's really grasped the nettle. So this is where it moves on to the housing market. So if you read headlines, you'll see an awful lot of talk about housing shortages pretty much everywhere. So Spain, housing crisis, slow construction is to blame. The UK needs to build another London to fix the house crisis. I don't really want another London, but okay. Look, Dublin's got a housing shortage too. I guess people are just not building houses everywhere because everyone forgot how to build houses. And there's America, make it count, measuring our housing supply shortage in the United States. This is amazing. All these housing shortages are cropping up in multiple places at once. So here's a little thought experiment. Imagine there's an office where 20 people go to work every day. One week, all the people in the office start to develop symptoms where their hair turns blue. They didn't dye it, by the way. They haven't gone punk. It just turns blue randomly. Scientific tests show it's not a virus, and it's not spreading to their households. So it's only these people in this office that are getting the blue hair symptom. So the scientists who did the testing conclude that there is something in the environment that's causing the hair to turn blue. Okay, it must be environmental. It's not viral. You're the lead scientist, and your job is to design the next phase of the research project. What do? Do you start by investigating the homes of all the office workers, or the office? It's pretty obviously the office, right? Because that's the commonality. So commonalities suggest a causal inference. We don't want to talk about econometrics or scientific inference or anything, but it's pretty obvious, right? If there's commonalities in something, that's probably where the cause lies. And the issue is that we're seeing Dublin, London, America, Spain. I could have come up with headlines for maybe most European countries there. And all of these are experiencing housing shortages at once. Really? So what's the commonality there? I mean, they haven't forgotten how to build houses. There's been bank lending restrictions in a lot of these countries as well. So what is the commonality here? Is it really a mass housing shortage? Has there been massive population growth? No, we've had terrible population growth. Birth rates are really bad right now. Population growth is so low that we have to bring in immigrants into a lot of countries. So why do people think that there's a housing shortage? What's the explanation? Very little evidence that's put forward for housing shortages. I think people just tend to fall back on an economics class that they went to in undergraduate that they took as a minor, you know. If the price goes up, it must be because supply went down, right? I mean, there's no other explanation in the world. Or demand could have gone up from private equity companies. Oh, just saying. And private equity companies, of course, are spreading all over the world. You can show that that's a commonality. You can show that these investment property purchases are taking place everywhere. Also, supply and demand. What's supply and demand? Okay, here are homes per person in Europe, in various European countries, right? That's homes per person. Since 1970, they've been rising in all these countries. So there's more homes per person today, significantly more homes per person today than there was in 1970. But the prices, no matter how you measure them relative to income, relative to rent, whatever, they're all higher. So where's the supply problem here? I mean, people go in houses. If there are more houses per people, you don't have a supply shortage, unless there's been a supply shortage since 1970 and it was so bad that people were living in tents. I don't know, but I don't think so. So that's just laying out the kind of question that we're putting out there. David's going to give us a really interesting related presentation on the Hungarian market itself, because that might leave people with questions of whether these dynamics are affecting housing prices and valuations here. After that, we'll talk about it more holistically. But for now, I'll hand it over to you, David. Thank you. Should come up. Thank you.
thrilled to be back at the Danube Institute, very grateful for the hospitality and the invitation. Now, relative to the rest of the world, the Hungarian real estate market, which has roughly tripled in price in the past dozen years, does not look by any means overvalued. That doesn't mean that there aren't distortions. It's difficult being a small, open economy because the great tides of monetary and fiscal policy around you are going to whipsaw your market no matter what you do about it. So if the world's central banks have a prolonged period of excessive monetary ease and zero interest rates, which pushes money into real assets such as homes, irrespective of where you are, that's going to overflow into you. And my own view, which I think is consistent with what Philip just presented, is that excessive monetary laxity by central banks over a prolonged period is the reason for the global housing boom. So being a hardcore free market advocate myself, there are situations where the government has to put its thumb on the scales because goods are not indifferent to each other. A pork belly future or a share in Apple computer and a house in the Budapest suburbs are not exactly the same thing because no one lives in an Apple share and no one lives in a pork belly future. Families have to raise children. People need a place to live. So to the extent that the market mechanism creates difficulties for family formation, the government should put its thumb on the scales, but it should do so in the least obtrusive, least disruptive way. And although there are times when we have to adjust the free market, where the state does intervene on behalf of the population, the trick, in my view, is to do it with the least disruption. The government should call it Goldman's law, should find the least disruptive minimum action that accomplishes the purpose and not create precedents for excessive intervention. So in this case, what I will argue is that a mortgage guarantee agency in Hungary would be the least disruptive and least costly way of addressing the housing problem. So if I could... So home prices have risen across the world, and Hungary's are the fastest of anyone. In fact, it's nearly 300% increase over the past dozen years. Czech is around 200, United States is around 200, and why should this be the case? Well, the main reason, I think, is catch-up, because Hungary, the Hungarian real estate market was undervalued relative to the rest of the world until quite recently. So if we simply take a scatter graph, if we compare GDP per capita on the horizontal axis to the price of city center real estate in US dollars per square meter, there's obviously a pretty close relationship. The USA is relatively cheap. Not surprisingly, Japan is relatively expensive. Hungary is right on the regression line. So although one could speak of a frothy real estate market globally, what's happened is that because of Hungary's improved economic prospects and higher quality of life and desirability as a place to live, Hungary has caught up with the rest of the world. So this is a high-class problem to have. I think it's a reflection of Hungary's success and the desirability of living in Hungary. Another reason for the rapid rise is because after communism, a lot of Hungarian homes were disgusting pits without running water, without flush toilets, and so forth. And that's the quality of real estate has vastly improved from effectively some of it at third world levels, now up to first world levels. So that's another explanation. Now, who is buying real estate? What do the Hungarians do as a people? Well, remarkably, Hungarians are some of the most conservative and prudent consumers in the world. Relative to income and relative to GDP, consumer credit is very low in Hungary. It's only about it's less than 20% of GDP, as opposed to between 40 and 50% in the euro area as a whole, and roughly 80% in the United States, which is not on the chart. So it's clearly not speculative excess by Hungarian households that account for this boom in prices. And the Hungarian government is kind of in a median position in terms of its indebtedness. Hungary's government debt as a percentage of GDP is around 80%, which is less than the Eurozone average, a bit more than its neighbors, Czech Republic and Poland. Now, prices are rising faster than rents. That's a good sign, because it means that the expectation of future rents is greater. If you take the price as a multiple of expected income, if the price is rising, it means that prospects for future income are going up. So that's a good sign. That's called the capitalization rate for real estate. And it's interesting because other assets in Hungary, particularly in the stock market, have miserable valuations. I think it's fair to say that Hungary has the most down-at-the-heels, beaten-up, miserable stock market of any of the industrial countries. Its price-to-earnings ratio is less than 6 times. That's opposed to, well, before the recent correction, about 26 times in the United States, and 18 to 20 for European stocks generally. That's partly because it's a very limited market. You have 3 stocks which dominate it. We can go into it, but one of the reasons that Hungarian stocks are so cheap, that the capitalization rate is so low, is because no one trusts Hungary not to monkey with the currency. So foreign investors are a bit leery of owning Hungarian stocks. And what that chart shows is that there's clearly an inverse relationship between the PE ratio on stocks, that's the blue line, fortunately it's a bit cut off, and the orange line is the foreign exchange rate to the US dollar. So if Hungary wants its corporate asset prices to perform better, it has to convince foreign investors that it will be more prudent in managing the currency. But that doesn't seem to matter for the real estate market, because it's a very long-term asset. People think that home prices will keep up with inflation. They'll be somewhat independent of the currency. And also, this is mainly bought by Hungarians for their own purposes, so different rules seem to apply. Now, Hungarians are some of the most responsible and hardest working and honest people in the world. How do we know that? Because if you look at the default rate for families with dependent children in Hungary, according to the OECD, they're right at the bottom of the range, well below the euro area, just around 2%, which is an extremely low mortgage default rate. Hungarians have, in Europe, the lowest inactivity rate of any national group. That blue line at the bottom, so the dotted line, sorry, is Hungary's inactivity rate. That's the percent of working age adults who don't have a job. The blue line below it is Japan. That's the legend was cut off. But in Europe, compare it to the United Kingdom, where something like 8% don't have a job, and Italy, it's 18%. The work ethic and the attention to meeting obligations of Hungarians is impressive. And the third thing, which is very important, obviously, for the housing market, is that Hungary has the highest rate of net migration in Central Europe. There is a brain drain problem. Smart young people, computer graduates, and so forth, do tend to leave the country. But because of the government's campaign to attract ethnic Hungarians from peripheral countries, Hungary is the recipient over the past generation of about 400,000 migrants net, more than any other country in Eastern Europe. So all these things show that there is a robust demand for housing. The brain drain is a different issue. Let's just... Now, about a quarter of mortgages in Hungary are subsidized in one way or the other by the government. However, as a percentage of GDP, Hungary's system of subsidies for mortgages is extremely low, which means that there should be some flexibility in improving it. Now that you've had this tripling of housing prices, young families are harder pressed to be able to buy a home in which to raise children. So the question is, what should be done about it and how that should be done? Well, what should be done, in my view, is that Hungary has plenty of room and very good reason to subsidize home purchases by families with young children. It subsidizes families through taxation and other policies, but I think it's extremely important to address the housing market because it may be a high-class problem to have, but it's still a problem for young families trying to find a home. Now, we found in the United States that we could promote the housing market not by subsidizing mortgages, and we do not subsidize mortgages in general, but we do have a system of guarantees of mortgages by state-sponsored companies, either state-owned or state-sponsored companies. Now, typically, the loss rate experienced by these guarantors is zero. Only during the 2008 great financial crisis did we get up to about not quite 4% as a loss rate. So effectively, the government enables borrowers who might not have the credit or the down payment to obtain the mortgage they need for a home to raise their family. It enables them at effectively zero cost. And it effectively self-funds because these packages of guaranteed mortgages are then sold as bonds to investors. Their credit quality is good as government debt, but they yield considerably more. So they're very popular as investment instruments for banks, insurance companies, and so forth. So that's the idea. I believe that the government can do a great deal of good for the population with a limited amount of expense by identifying the housing market problem as a high-class problem to have, looking to help families who are trying to buy a home, and using guarantees, which are the least intrusive, least distorting way of intervening in the market, using a scalpel instead of a sledgehammer, and do a lot of good. It should also be, I think, quite a popular measure. So with that, thank you very much.
Thank you, David. That was great. Free investment advice. There you go. So actually, let's talk about the investment angle before we get on to the housing market angle, because the meat here, as far as I can see, is the housing crisis that we're seeing in the West. Not so much here. It's not as bad here, but there are some murmurings that houses are becoming unaffordable for young people, as David said, and we don't probably want it to get to the extent that we'll talk about in Ireland and other countries like that. And some of David's suggestions might point in that direction. But just before we get into the issues with the housing market and potential investment firms, private equity and so on, we might as well ask the straight question. I mean, from what you're saying, the Hungarian stock market is cheap, but complicated because it's dominated by three firms and so on, so we won't go into that too much. But you think property's pretty good value here, right? All things told.
Well, 85% of the market cap of the Hungarian stock market is three companies: a bank, an oil company, and a mobile phone company. All of those are mature businesses without terrific growth prospects. So you basically have to analyze three stocks as opposed to try to analyze an index, because you don't really have an index, you just have three companies. The big question is, why have there not been more companies seeking to raise money on the stock market? Well, part of it is just a vicious cycle. If you have to pay, many times your earnings for capital, I mean, the inverse of a 6% PE ratio is an earnings to price ratio of about 16%, right? Which is a lot for capital. That's paying a lot. It's expensive. So equity capital is not attractive, and if you don't have people coming into the equity market, the equity prices remain depressed. So what you really need in Hungary, I think, is a venture capital industry, not private equity, but a venture capital industry which identifies new companies, builds them up, and then brings them to the stock market. Foreign investors are not going to be terribly happy about the Hungarian stock market, which is denominated in forint, as long as the forint seems likely to get devalued against the euro. And unfortunately, during COVID, the central bank, I think, made a mistake by letting the forint slip too much. That increased inflation, and it hurt confidence. And you can see, just in terms of time series analysis, econometrically, that there's a relationship between low valuations in the stock market and the depreciation of the forint. So there's a monetary macroeconomic dimension, there's an industrial organization dimension, and it will take some time to build that up. But the housing market, on the other hand, is a very large market with millions of participants, and it behaves very differently.
And it's fairly reasonably valued. I mean, some of the other housing markets seem to me, anyway, quite overvalued in Europe. But the Hungarian one, according to your research, looks okay, really.
Well, yes, it does. But it's certainly valued right on the regression line of per capita GDP versus home price. Now, of course, the whole world could be overvalued, but at least this means that Hungary's overvaluation, were that the case, is no greater than the rest of the world. And the fact that default rates are extremely low is very encouraging. If housing were overvalued and people were buying houses they couldn't afford, you'd expect to see higher default rates, but default rates have been going down. So that's partly a question of the character and work ethic of the people, but it's also an indicator of credit quality.
Okay, I think that concludes the investment portion of the panel.
You don't want to ask a journalist for investment advice.
We shouldn't ask anyone for investment advice, really. Let's actually start talking.
Well, could I just say, I think part of the reason why property became so popular is because of the low interest environment, and that's why A lot of investors kind of started investing in housing because there was a low yield on a lot of other things like government bonds, for instance, and so that's why housing became such a popular investment kind of mechanism, just because of the low yield environment or the low interest rate environment across the board.
Yeah, and I think that drove both older people who wanted to put their money into assets, and that's a lot of it, cash buyers in markets right now. But the private equity stuff, I think, really, if we're correct, it's a hypothesis, of course, but that really kind of juiced it. But I suppose we might get back to the technicals and to the mechanics of it and all that. But you did this report for the Irish Parliament, and I read it, and some of it talked a lot about, I don't so much mean the historical stuff about Ireland, I don't think that will be so relevant for Hungary, but the politics around this, because this is kind of a young versus old thing, really, isn't it?
Yeah, I feel like it's kind of the boomers versus the zoomers. You know, the boomers are in their house, they own it. It might be tied to like their pension fund or whatever, or their pension. And I feel like a lot of people my age and my age bracket are just kind of, you know, begging to have a place that we could call home. Like we're either forced to live with our parents or forced to pay high rents. You know, we're expected to put down like a 10 to 20% deposit on the value of a house. And, you know, previous generations, that was unheard of. So I do believe like the housing crisis is kind of pitting the younger generation against the younger generation against the older generation. I think it could have deep societal implications if it persists.
David, what's your impression of this? I mean, obviously it's seeping into Hungary a little bit, but it's not as bad here as it is in the Anglo countries and probably in the west of Europe as well. Have you given much thought to the, I don't know, intergenerational dynamics or the political dynamics of these incredibly high property valuation environment?
Well, to some extent, this is happenstance. Any rise in home prices, any rise in asset prices is likely to benefit people who have assets. Now, capital markets really are simply about old people lending to young people, because young people are characteristic borrowers. They have to build a family, buy a home, and they need to borrow money to do so. And when they get ready to retire, they want to lend money and live off the interest. So the simplest example is you buy a house. You borrow money to buy a house when you're young. Your children go off, and then you sell the house and you live on the proceeds. That's actually a very typical retirement pattern. So anytime asset prices go up, it'll benefit older people simply because in the normal human life cycle, older people have more savings. They have more wealth. Now, to the extent this creates distortions and makes assets that are necessary for family formation inaccessible to young families, government has a very good reason, as I said, to intervene, to put its thumb on the scales. As a free marketer, I believe in leaving the market mechanism alone, but the family is more important because it's the fundament of society. And again, the question is how to do this in the least disruptive way. The most disruptive way is you arrest the old people, expropriate them, send them by force to an old folks' home, and give the houses to young people. That's sort of a communist way to do it. That would be the extreme...
David, don't advocate these things at the dining table.
Give me a good idea.
Extreme disruptive way of doing it, and we gave up doing that in the United States 3 or 4 years ago. And the least disruptive way is to use a minimum of government funding, and I've suggested guarantees is the way of using the minimum of government funding to nudge the scales towards younger families.
Yeah, I would agree and disagree, but what I would say, like I do agree there is too much regulation. I mean, the fact is that like the main banks have stopped lending, especially in the Irish case. I believe bank lending is down like 80% from its peak in 2003. Now, maybe there might have been too much lending during the Celtic Tiger, but certainly, you know, nature abhors a vacuum, and I feel like private equity and private credit has kind of filled that void, and it's clear in the data. So you could argue there is a bit too much regulation, but I suppose just in terms of this kind of free market mindset, you know, during the Celtic Tiger, and for those not aware, the Celtic Tiger refers to the boom in Ireland. It's based off the the success of the Asian tiger countries. And so, during that period, you saw a lot of loose lending to borrowers and a lot of loans given out to developers to build a lot of houses or whatever. And then once the housing bubble burst, the government stepped in and corrected the market, so to speak. So I suppose, there is too much regulation now, I would agree with you there, but I suppose this kind of free market mindset kind of falls flat when the government actually does have to intervene and guarantee deposits and help developers and recapitalize housing prices as they did when, in many ways, especially in the Irish case, they incentivized a lot of these private equity vehicles to come into the country to recapitalize the banks and to keep house prices high again. So they don't really believe in the free market mindset in absolute terms.
Well, can I just say that what's happened with private equity is actually slightly different, and I think it introduces a slightly new problem into the housing market. Maybe I'm wrong, and tell me if you think otherwise. But even in the excessive boom years in Western countries, when there was a housing bubble, it was mainly caused by bank overlending, call it what you will. I mean, the loans came from the banks, right? They came mortgage-backed securities and so on. The regulations that have been put in place have stymied a lot of that. We see that in mortgage applications and so on. But the money if again, hypothesis, but the money that seems to have replaced that comes in as private equity. Now, back in 2007, 2006, call it when you will, a young family would go in the United States and Ireland and Britain, and they take out a loan and they buy a house probably that they can't afford at too high a price relative to their income. But they'd buy a house. They'd get a house, at least for a while, until the bailiff came and threw them out. And, the government had to absorb it and all that mess. But the goal was to take out the mortgage and then buy the house and then live in the house. The money that's currently being lent by the kind of non-banking sector, shadow banking sector, call it what you want, the goal there, they're taking the same savings from the older people. I mean, they're the ones investing in private equity for sure. But they're then buying up the house as an asset and renting it. And so what we're seeing develop isn't at the very least, the housing bubble era had an ownership model at the heart of it, even though it was a highly defective ownership model run on cheap money, as you say. But now it's developing into this buy-to-rent rentier economy or something. I mean, do you have any thoughts on that? It's not markets can work given what they're geared toward. If they're geared toward home ownership, they'll produce home ownership style results. But it seems to me increasingly geared toward treating the house as an asset and using it to extract a rental yield out of, right?
Well, the question is, why would you buy instead of rent? There are some markets like the UK where people historically want to buy, and some markets like Germany where people historically like to rent. America is a buying market. There's also a tax break for buying. Mortgage interest and real estate taxes are deductible from other taxable income. So for most people, owning a home is considerably cheaper after tax. What happened in the United States after 2008 is a collapse of the credit quality of prospective home buyers combined with a tightening of credit standards. During the 2000s, there was a great conspiracy to criminalize the American public by making it easy to falsify mortgage applications. And it's estimated that about 10 million Americans falsified mortgage applications with the banks looking the other way, wink and nod. That's a felony in the United States. It's a serious crime. And I think the banks did it because once you criminalized 10 million Americans, it was hard to send the bankers to jail. For facilitating a crime, you'd have to put everybody in jail. So the mass criminalization, felonization of Americans was done intentionally, and that ruined credit quality for very large numbers of people. In general, I think there is a great advantage to buying over renting. If you buy a property, you're more likely to maintain it. And unlike many other assets, the owner of a house has a very large part of the responsibility for maintaining the quality of the asset. Renters are less likely to do it unless, of course, they're Germans who will, do what they're told in any case. So I think that the shift towards the private equity renting model represents a deterioration in quality of life. Certainly in the United States, maybe not in every market, but definitely in the US.
I suppose it depends how you view housing, because I would view housing as a public good. And I feel like once you privatize it and allow people to kind of invest in it willy-nilly, it's prone to the kind of boom-bust cycle, as any business cycle is. And I think it was John Maynard Keynes who predicted that if you allow the provision of public goods to be done by private forces, you run the risk of that. And I feel like that's what we are seeing in the housing market. Especially in the Irish case, we were traditionally a home-owning country, so it's kind of a culture shock now to see so many renters, particularly young people. Back in the day, the 1990s, I think it was 15% of young people would have been renting. Now it's like 50%. 90% of supply in Dublin City is now built to rent, and there are all sorts of reasons for it. But if you go on a lot of the websites of these property companies, they brag about the high-yielding Irish rental market, particularly the Dublin market. One of them is Vanke, which is a Chinese qualified investor alternative investment fund. And a lot of these qualified investor alternative investment funds, it's quite a tongue twister, they're exempt from a lot of taxes like capital gains and VAT and things like that. So they're utilizing a lot of these. It's not really tax dodging, because they're not like dodging tax. They are prevented from paying it. But they're using a lot of these structures to invest in the high-yielding rental market and paying little to no tax. And I think it's very pernicious, I would say.
Yeah, one of the reasons I asked Theo to come along, okay, I'm Irish as well, so it might just be some sort of bias, but the funny thing about Ireland is it's seen, because of the economic development that's taken place there and the hyper-financialization of the country, a lot of the trends that we've seen in the world, in the Western world, have almost been like on turbo in Ireland. Like anything that, like if you take the private equity model and you go and you try and scope it out in America, you'll see pockets of it. It's big in Texas, for example. It's big in Dallas and so on. But in Ireland, it's been concentrated on a small country that is kind of obsessed with financialization, creating loopholes for financial investors to extract money and so on. So that's just to give some context. The situation in Ireland is so extreme. And I think it's kind of indicative of not the perfect case, but the worst case, in a sense, that you can go in that kind of a direction. So just before I go back to David, I'd like a kind of intuitive level, because people probably aren't actually familiar with it. Like, this is really deeply felt in Irish culture, right?
Well, Ireland is obviously a very small country, small population or whatever. But, traditionally, we would have been a very agrarian society. And then we went from agrarian to kind of simple manufacturing, and then we never really excelled into kind of advanced manufacturing. We catapulted to services, and now we're a very services-oriented economy. And obviously we had to do a lot of things in order to excel up the economic scale, and one of those was obviously the low corporate tax rate that Donald Trump seems to have an issue with now, and kind of understandably so. But also there's these other mechanisms. So we set up the International Financial Services Centre, which is kind of our equivalent of the City of London. And what we allowed people to do, we just wanted to encourage a flow of international capital into the IFSC. And so we set up these opaque, kind of nebulous structures like special purpose vehicles, for instance. I think that was in 1997. So if you set up a special purpose vehicle, you can essentially warehouse assets, and you're exempt from a lot of those taxes that the qualified investor funds are also exempt from, like VAT and capital gains. And a lot of these private equity vehicles, what they have done is they have used those pre-existing structures in order to warehouse assets, mainly property, in the IFSC to avoid those taxes. And now the shadow banking sector, as you alluded to in the intro, I believe Ireland is the fourth largest shadow banking sector. It has the fourth largest shadow banking sector in the world. I mean, think of it, small Ireland, yet it has this...
Not per capita.
Not per capita, no. I think it's worth 3 trillion, which is a huge figure. So obviously shadow banking is credit intermediation outside the kind of regular banking system. And the problem is like they're primarily involved in the provision of housing, because again, the main pillar banks are constrained in terms of what they can lend because of regulation. They have a lot more capital requirement ratios, for instance, more so than any other EU member state. So the banks are actually kind of prevented from lending, yet they're deposit rich. So what the private equity vehicles what they have done is they've kind of filled that void and warehoused a lot of those assets in the IFSC, and I think that accounts for the large shadow banking presence. And I think the issue is like, if house prices are to fall, who's going to pick up the bill? Because like we were told that, like, you know, after Lehman collapsed, our domestic regulators informed us and you know, promised us that this won't have the credit crunch effect won't happen to Ireland. You know, we'll still be able to access the international money markets. And when push came to shove, it turns out that we couldn't. And I just fear, you know, history could be repeating itself, and instead of, you know, Jean-Claude Juncker calling Dublin and warning of a financial bomb if you don't save the banks, it could be, you know, Donald Trump saying, you know, oh, a lot of American pension funds are tied up in Ireland because of this huge shadow banking sector that you guys have. Maybe you should bail them out. In fact, you have to bail them out, or I'll lure the pharma companies to come back. You know, I think it could get very serious for Ireland. I think Ireland is on the precipice of a very serious financial catastrophe.
Yeah, being in Hungary right now, Ireland's about half the size of Hungary, but Hungary, in terms of it's seen quite rapid development as Ireland was in the late 1990s, and I think everything seems pretty okay in the housing market right now, but I would highlight these issues, that this is a danger for a rapidly growing country, especially one that wants to attract financial inflows and so on. It's remediable, I think, but it's something probably to keep in mind and not to get too excited. Even if some sort of a crash doesn't occur, which it could, let's be honest, it could. Even if it doesn't occur, just the very fact that this is, as you say, it's a very much a buying society in Ireland, very much so like America, and nobody buys houses anymore. It's completely changed the culture. And by the way, you didn't mention it, but there's massive... Ireland is apparently the wealthiest country in Europe, but there is massive net migration of Irish people going to Australia, Canada, and so on. Why is the wealthiest country in Europe exporting its citizens? It's completely bizarre when you look into the statistics. David, I just wanted to ask you... my presentation, I'm quite skeptical of the idea that there's any lack of supply in the housing markets in many of the Western countries. Maybe I'm taking the kind of extreme position on that. Do you think there's anything to the supply arguments? Do you think there is any housing shortages in any of these countries, or not?
Well, there are plenty of places where there are locally housing shortages and places where there are gigantic oversupply. New York City has a housing shortage at the moment. There's no supply on the market at all for rentals and virtually nothing available to buy. But there are very few transactions being consummated. I don't have a global overview of that.
Yeah, I think part of the reason, I agree with you, that part of the reason that people get very focused on this supply issue is because a lot of people are moving to cities because the higher paid jobs are increasingly concentrated in urban areas, and they see a lack of space. Not a physical lack of space. I mean, if there is physically not enough space, people will turn up homeless, provided everyone has a roof over their head. There is no actual physical shortage of houses by definition, in a sense. But I think it's that being packed into cities that's driving this perception, at least, that there's a supply crisis.
I suppose in the Irish case, I mean, we have like over 100,000 vacant properties scattered across the country, yet we keep getting all these figures from these various, you know, stockbrokers saying we need X amount of homes, you know, 50,000, 60,000, 66,000 homes, you know, why not a billion, you know, I don't know, it seems very arbitrary. And so I suppose, given that, you know, we do have this wide amount of housing stock that is being let vacant, why can't we tap into that? And a lot of these private equity vehicles and a lot of these private sources will leave those properties vacant until to increase the yield and to also get some more tenants in there, more high-paying tenants, I suppose. And I suppose part of the reason why there's an incentive for private equity to get involved in the Irish housing market is because we're a very tech-oriented economy, and most people in the tech sector, you know, are renting. And I think there's this kind of conflict, I suppose, maybe between the indigenous society, who would have been largely home-owning, and this kind of new class of tenants who are coming in mainly from abroad, places like India, who are used to renting, and well, not used to renting, but it suits them more to rent because, for instance, just a bit of history, Ireland had its own version of right to buy back in 1966, I believe. We always hear about Margaret Thatcher's right to buy, but Ireland actually had that in place before then. And so I believe by 1971, close to 2/3 of people in Ireland were, buyers and had their own home, compared to like 50% in places like Britain, for instance. And so it's a real culture shock now to see such a high rate of rentiers.
David, on the supply side argument again, I think it's worth dwelling on, not so much because it's firmly based in reality, but it's incredibly popular. There's a whole movement, in a sense, called the Yimbyism, that this yes in my backyard, that we should tear down regulations and build as much properties as possible. What do you make of that? I mean, there's a lot to be said about it, but at the very least, if you diminish building regulations in any environment, you will inevitably get worse, or at least uglier, or less livable buildings. Do you have any thoughts in that direction?
Well, Santa Fe, New Mexico requires everything to look like adobe buildings. So it's an entire city built in fake adobe. It's enormously popular among American retirees and countercultural environmentalists. I think it's probably the ugliest city in the world. I prefer Lagos or Nairobi. I'm a strong believer in zoning standards. I'm a Roger Scruton conservative when it comes to architecture. I think this is a matter of quality of life, and one of the great proofs of this is the wonderful city of Budapest, which is is certainly as lovely as any capital city in the world. You can pick and choose. And the fact that Hungary, which is a relatively small and relatively poor country, boasts a capital of this quality is an enormous asset.
And the smaller cities are extremely charming as well. It's not just Budapest.
Yes, quite right.
Yeah, just on the whole Yimby thing, it's funny because Ireland doesn't have a lot of think tanks, but this recent think tank came up, sprung up, called Progress Ireland. I know some of the guys involved, great people, thinking outside the box, but they are literally, yes, in my backyard, because their big proposal recently was that you would build sheds outside your parents' home, and that's where you could move into. So they took it, literally the yes in my backyard. And I feel that is the logical conclusion to this obsession with supply. If your only thought process is supply, there's no such thing as bad supply. And so what's the problem with moving into your parents' backyard? That is technically supply, but it doesn't really address the societal issue, which I would argue is the commodification of housing.
Yeah, again, for the Hungarian audience, I mean, I'm sure many people have been around internationally, but one of the things that's striking when you move here is the quality of the construction. The houses, the fairly new builds are of a very, very high standards. I know it's unpopular to say, but even some of the communist buildings are better built than some of these new builds that you'll see in especially Anglo countries that have kind of demolished their regulatory standards. They'll throw up a building very quickly, and it doesn't really matter if the door frames fall apart in 5 years because you've already flipped the building. It's getting very, very bad, and I think you've alluded to it there that there's kind of an incentive if you have if you're driving this supply side argument, which may eventually seep in here. I'm not sure. Maybe we're kind of preventing it by talking about it, but when the supply side argument comes in, there's a very strong incentive for builders to astroturf these movements, right? To try and get regulations down.
Yeah, well, I'm not implying that Progress Ireland,
the
think tank I alluded to, are beholden to builders. I think they're just using their own initiative. But I suppose part of the problem, I would argue, is that Dublin does have a distinctive look. If you ever go to the capital of Ireland, it doesn't look like every other European city, and I kind of like that about it. And I think a lot of these people, the Progress Ireland types and the Yimby types, they definitely want to homogenize Dublin so it looks like all these other cities, with the high rise or whatever. But it's not even high rise, they just want to create these kind of like pods where people will own nothing and be happy, and I suppose that is kind of their mindset. And I would argue it's a bit foolhardy because when we were, a very poor country, we were, building 10 times as many homes.
And nicer homes.
Very nice homes. Now, I mean, they did cut costs. They didn't put in a lot of amenities in a lot of these estates, places like Marino. I know the audience might not be familiar with these housing estates, but they definitely did have kind of lax standards in terms of providing amenities for the public. But I suppose Ireland may not have a choice now because, we might touch on it later, but the whole commercial property issue, it didn't really play a role in the last bubble. The last bubble was more residential, but you're seeing now commercial play an increasing role, and I think it's because, during the low interest environment, they invested a lot in office space because they thought they would hire all these people. And it turns out that the working from home environment persisted post-COVID, and now a lot of these commercial property sites are vacant. And it's really pernicious in Ireland. Like, what they're doing now is they're turning to these commercial property owners and saying, why don't you house a few immigrants instead? Why don't you house this influx of migrants we've seen over the last number of years? And a lot of these property developers were kind of, they went bust in the last crash. They were bailed out by the state's bad bank, and now the state is coming in and telling these people, you can house these immigrants as another sort of bailout. And it's, again, I think it could have societal implications.
Just quickly on the commercial property, there's been a big kind of neutron bomb let off in the commercial property markets all around the world, but especially in these so-called wealthy capitals. And I'll just give an anecdote. I stayed in London in the centre just a few weeks ago, and it was one of these kind of semi-Airbnbs, but advertised as a kind of a hotel situation. And I went up, and it was an office building that had been converted into housing, but only half converted. So the entire wall was translucent, right? It was just like in an office building, and they just covered it in kind of blinds. It was the strangest place I've ever stayed. Now they charged a normal hotel price for it, but it wasn't a normal room, and you can imagine the running water facilities probably didn't work very well. So
I think the problem in Dublin, and I've spoken to people involved in this space, is a lot of the sites are very one-dimensional. They can't really be upgraded or converted into housing. They serve a specific purpose to serve as office blocks. So I think that's why you're seeing a big push by a lot of these tech moguls now to get people back in the office. Because, as you know, as I alluded to earlier, Ireland has a very low corporate tax rate, and a lot of tech companies, your Googles, Facebook, or whatever, they've invested a lot in Ireland. They all have their European HQs in Dublin, and so that's why you have such a big tech sector in the country, and why you have a lot of tech workers, again, who primarily rent. So that's why you're seeing such a big influx in renters in the country that traditionally were homeowners.
Well, trust me, if you leave those office buildings vacant long enough, you will get a translucent pod. That's exactly what's happening in London at the moment. So we're coming up slightly on time. So, David, I think the paradox, if there is one, is that Hungary is, to my mind, where Ireland was when I was growing up. It's on the cusp of becoming a quite wealthy country. I think we're probably in agreement it will over the next 10 or 20 years. We're seeing the very beginnings of complaints about housing affordability. It's still not that bad here, but you hear whispers about it. You hear murmurs. I don't think it's as bad coming from a place with kind of chronic problems in that direction. So obviously you have your ideas about subsidization, but do you want to speak more generally about how Hungary should approach this? They don't want to halt economic development to keep property valuations low. On the other hand, we don't really want to have this situation. I mean, Ireland's an extreme example, but maybe you have further thoughts on that, or maybe you'd just like to tie your mortgage.
Per capita, I think the average annual compensation for Hungarian workers is roughly about 25,000 euros, which is well below some of its richer neighbors. That's a holdover, a bad hangover, let's say, from communism, and obviously that should equalize over time. So Hungarian wages should, in nominal terms, rise much more rapidly than its neighbors as Hungary plays catch-up to equalize compensation, because the kind of work that Hungarians do, say, producing auto parts or building EVs for BYD, is really no less productive than what the Germans and Austrians do. So there should be rising incomes over time, and to the extent that real estate prices, home prices, have run ahead of rents, this presumably anticipates that the ability to pay rents in the future is going to rise quickly. And that makes sense. That would simply be Hungary playing catch-up and normalizing its income profile with respect to neighbors who did not have the misfortune of being occupied by the Russians for so many decades. So in that respect, I think the increase in real estate prices anticipates a natural and salubrious development. It's a good thing, it's not a bad thing. It's a high-class problem to have. But when you have an increase in asset prices, as we were discussing before, it benefits the people who've got the assets, not the people who need the assets. We're not talking about a painting or a bottle of wine, but a residence in which to raise a family. So it has a social function as well as a commercial function. And that's why the government should intervene in the most efficient way to make houses more affordable to people who do not yet own them. It should be a comfort to people, to young families who obviously have to save and sacrifice other things in order to buy a house, that the prospects for the appreciation of their house are good. So they're buying an asset which is likely to gain in value. I think these are fairly straightforward things, and the question is how public policy can best reconcile the freedom of the marketplace and the social needs represented by certain assets, particularly residences.
Yeah, I mean, obviously high asset prices is the sign or the mark of a healthy economy, and my Prime Minister, Taoiseach, was in the White House recently, and Donald Trump said, do you know why they have a housing crisis? Because they're doing so well. And it didn't really play well with the domestic audience, but Trump in his kind of straight shooting way, he was alluding to an inherent truth that, like, obviously high house prices doesn't mean your economy is doing well, but I suppose house prices are at their housing boom peak, and they're actually above that. And I suppose that is the sign of a healthy economy. But I guess if your thinking is very one-dimensional, and if your only priority is to increase house prices and not actually address affordability, I suppose it is the mark of a healthy economy, because I believe house prices are 7 times incomes now and 10 times income when it comes to the city itself. And similar to, you alluded to there, rents actually are, you're paying more in rent than you are on a mortgage in Ireland, but because borrowers are really constrained in terms of what they can borrow as a legacy of the crash, they're prevented from even putting down a deposit in the first place, so they have no choice but to rent. And they're paying an extortionate amount of rent. And again, because you're seeing a large influx of foreign tech workers, they're earning way above the average wage. So the average wage in Ireland is around 42,000, I believe, whereas these workers are earning like 60,000, and they comprise 15% of the workforce. And they're inflating the prices of everyday goods and rents themselves, and because they're in these high salary positions in the Googles and Facebooks or whatever, it's really pitting people who are already settled in the country between one another.
Just before we turn to questions, could you really briefly say something about the investment industry and the private equity industry? Like, what would Hungary watch out for? I don't think that industry, in terms of the housing market, is here at the moment. But some of the presentations that David's given, if you just run a straight regression through it, Hungary is a pretty attractive market. If the investors eventually figure it out, they might come here. Now, it won't be as extreme as Ireland, because Ireland has the IFSC. It so aggressively tries to magnetise these people. But
no, it wasn't deliberate. They used a lot of these pre-existing structures to take advantage of the tax code. But it wasn't like a lot of these incentives were there specifically for them. It was to encourage inward investment, because again, a traditionally very poor economy. But however, post-crash, our finance minister, Michael Noonan, he met with a lot of these private equity vehicles, your Apollos, Global Management, Lone Star Capital, which is based in Texas. And he told them about a lot of these structures. He alluded to the fact that, you can set up as a special purpose vehicle and avoid VAT, capital gains or whatever, because his only kind of goal was to recapitalize Irish house prices. And so what would I watch out for? Again, the problem with Ireland is, you might have a housing estate that's built for first-time buyers, and these funds will swoop in and buy out the entire estate for a high rental yield. There was a housing estate in a place called Maynooth, and it was bought by, I think, a New York-based hedge fund, Roundhill Capital. It was 170 units. First-time buyers were about to step in and potentially buy these places, and they just kind of swooped in overnight and bought the entire estate. And again, on their website, they brag about the high-yield Irish rental market, because again, their only kind of incentive to go into the housing market is to acquire a high yield, which invariably translates into a flurry of build-to-rent properties, all over the country that may have initially been destined for first-time buyers.
Okay, so we're running short on time. We started a little bit late, so let's try and get a few questions in, maybe.
Yeah, so there were various interesting strands in this conversation, and I'm really fascinated by this argument, Philip, that you put up, where you say it's not a supply crisis. And I want you to help me here, because you kind of persuaded me 90%, and then I got all excited, but you lost me at the last turn. So it is true that all over the Western world, we have these headlines saying we have a housing crisis, and it relates to these very peculiar local circumstances. That's unrealistic. There must be a common cause here. So what is the cause? And then you say, okay, we have this standard economics model of supply demand, and you showed some, you indicated that it was going to be much more complex or more interesting than that. But then you kind of left me hanging there. And then strangely enough, you showed a graph that showed that the houses per 1,000 people have been increasing, which shows that households have been getting smaller, which is logical because we have less children and more marriages are breaking up, right? But doesn't that actually show that there is a supply crisis? Because even if you have the same population in, let's say, the Netherlands or Ireland or Hungary, if then people massively get divorced at a much higher rate than they used to a generation before, and now you have all these smaller households, then the people are less efficiently distributed over your houses. So now you need more houses, but you don't have those houses. So there's a lack of supply. So there is a supply crisis in the sense that the supply would have been enough had we still had the household structure that we had a generation ago, but we now have a new household structure, and for that there is a lack of supply.
I apologize. I only had 10 minutes, and I probably spent 15 minutes presenting, so I probably could give a better explanation of it. I do actually have an economic model I'm working on, but in terms of the smaller household size and so on, I've heard that explanation. I'm open to it, but it needs to be proved. You need to actually show. You need to show the numbers. You'd need to say, okay, average household size has gone down by X. Yeah. Houses to people has gone up by X. Y is smaller than X. You'd need to do that. My intuition is probably not. I mean, you'd probably have to argue that, average household size is halved or something like that. As well as that, you can split a house and turn it into 2 flats if you want, I mean, the market should, in theory, adjust to changes in family size, if you see what I mean. So you could have, I used to live in Wimbledon. It was a very large house. I guess it used to be a mansion. It was stripped down 3 floors. Right, so they just built 3 apartments into it, and that would become 3 homes. That would be classified as 3 homes. In that regard, I think the market should adjust, because if you have one person, if you're a single person, for example, and you're going and trying to buy a house here, you're not going to buy a 5-bedroom house, right? You're going to go and you're going to look for a 2-bedroom apartment, maybe, if you want to. So the market should adjust to that. It's a reasonable argument, but it would have to be proved. But my only it's a quick presentation, but my only kind of argument there is, you saw the headlines, and then I put up statistics that at least on their face look like houses per people are growing. People should address that. Those statistics aren't shown in those articles. I've followed it for 4 years. We've been talking about it for 4 years or something. I've been following it. They don't show this, and I've argued with some pretty prominent Yimbys in the United Kingdom, and I've shown them these statistics, and I've said there's much more houses per person. And they don't really have an argument against it. The interesting thing is, the supply side argument, the Yimby argument, it's never been made empirically. And you can go, because I've looked and I've debated with these guys, there's no paper that you can point me to show me evidence of a supply crisis. I promise you that. And if you can find me one, email me and I'll do another panel on it. But I've not been able to find a single decent econometric or even just non-econometric, just data-driven study showing that there's a serious supply problem. I know that sounds bizarre. I know it sounds really strange, but that's been
I think we're kind of dealing with a distorted market. Like, again, I referenced the Celtic tiger. So in Ireland, that's our own version of the kind of the buoyancy of the East Asian tigers, your Singapore, South Korea, and what have you. We were building close to 90,000 homes per year, which was the highest per capita than close to any nation on earth. Yet house prices still rose. So what does that tell you about these kind of normative supply and demand theories? I don't think they apply in this distorted, financialized economy and particularly housing market.
So thank you all, first of all, for the informative talk. I have a question for David. What's your view on the housing outlook in Hungary if or when it joins the euro?
For small, open economies, currency predictability is almost inevitably a benefit to asset prices, unless it comes at the expense of a severe distortion of monetary policies. There are cases where small open economies cannot manage to maintain stability against currency reference. For example, Argentina under Domingo Cavallo during the, around 2000. But in Hungary's case, I think that if anything, the foreign should try to appreciate against the euro. If the intention is to join the eurozone, I would try to join it at a higher level than present and create expectations of euro strength. That would, without any doubt, attract a significant class of investors who'd like to own Hungarian assets but do not wish to take the currency risk. And that would be across the board. There are people who want second homes. There are investors in businesses, investments in farmland. I think it would be an enormous boom to Hungarian investment, and it would raise asset prices. There's no, I shouldn't say there's no doubt. There's a very good econometric case that can be made that the very low valuation of Hungarian equities is due to, in significant measure, to the depreciation of the currency and the expectations that it generated. So yes, that would be a big boost for Hungarian asset prices.
I suppose the first housing bubble had to burst to allow, I suppose, more countries into the euro, because I think the euro was set up for more political reasons as opposed to economic, because it was a monetary union without a fiscal base. And I suppose post-crash, you saw the setting up of the Fiscal Compact Treaty, for instance, which tried to alleviate some of those fiscal issues with it. I suppose I had a big shock in Ireland because we were used to mortgage rates of like 10%, and then overnight when we joined the euro, they were lowered to like 5%, for instance. And it really had a big impact on the pigs. So Portugal, Ireland, Greece, Spain, and Ireland was hit particularly hard because, again, you had a lack of exchange controls and access to cheap credit, which just kind of exacerbated the housing bubble in many ways. Because again, you had obviously our own banks who were engaging in loose lending, but part of the reason why they were doing that is, again, because of this access to cheap credit that we weren't really used to. So I suppose there isn't as much of a risk now, given that they do have some of those fiscal safeguards in check, but it definitely had a huge impact in terms of exacerbating the Irish housing bubble. And I don't think you would have had as big a bubble if it weren't for that. But I suppose in keeping with the theme of tonight, the private equity topic, I suppose because interest rates were so low for so long, especially during COVID or whatever, they also had that access to cheap credit, but they weren't regulated like the main banks. So again, it could be a case of history repeating itself.
Yeah, I just really emphasize that if Hungary were to join the euro, Hungary's been used to relatively high interest rates for a very long time. Now, it's not so much on mortgage rates. It's a very complex market here. I won't get into it. I'm learning about it day by day. But you can just imagine that forint interest rates, which are, high single digits, would immediately go down to German Bund levels. It would have, if I were the government managing that, I'd take Ireland as an example, which also used to have quite high interest rates, and be careful with that. And the second thing I'd say about it is, I've noticed actually the very top tier, or at least the top, I don't know, maybe 5% of the rental market here is already in euros. If you go to the 12th district and so on, the rent is in euros. It's an interesting arbitrage play, that's all I'll say about it. Anybody else? Stefano?
Yes, very quick question. Regarding foreign buyers and their impacts on the high demand markets such as Ireland, for example. A couple of years ago, New Zealand banned all foreign buyers from its real estate market except from Australia and Singapore. Now, I don't know what were the practical outcomes of that, but I remember that at that time there were calls across the Anglosphere for that measure to be replicated. Do you think that, just to specify, non-resident foreign buyers, so of course someone with a residence right would have the right, do you think that implementing such a policy might have a positive impact on the housing bubble in countries with a high demand, or would it be counterproductive?
Demand curves usually slope downward. So it's very hard to imagine that eliminating a category of prospective demand would raise prices as opposed to cut them. As I said before, I think that there are very good reasons in the housing market to manipulate the market and go against free market results, but I favor the minimum intervention, the least intervention that effectively accomplishes the goal. Banning a class of investors is kind of an extreme solution.
Yeah, I actually called for it in my report. I do think we should follow the New Zealand model. Canada has also implemented something similar.
Spain?
Spain is talking about it. I don't think they have done it yet. The Prime Minister there implied that he's looking at it. Because I suppose right now what the Irish state is trying to do is they're trying to prevent the bulk purchasing of homes. So if you buy 10 or more properties, you're hit with higher taxes. But again, it's water off a duck's back for these cash-strapped companies. It makes no difference to them. So I suppose banning them would alleviate that because, again, of their incentives to just invest in build to rent and keep the prices high or whatever. But I suppose, what we need to prioritize is more proactive solutions. So it'd be very easy to ban foreign purchasers. And by the way, we actually are allowed to do it. Some people argue, we're constrained by the EU or whatever. But I believe the former Financial Services Commissioner implied that you can do it under a common good mechanism. Or something to that effect. But again, we need to start getting our domestic pillar banks involved in the provision of credit to construction activities. Because again, we have all those safeguards in check, like the macroprudential rules, which prevent you from borrowing a certain amount of your income into housing or whatever. So I believe we have a lot of safeguards in place to prevent some of the shenanigans that occurred during the boom. So I don't see why we should, not incentivize the banks to start lending again, given we have a lot of those safeguards in check and we've already been through the housing bubble. So, but again, it would be very easy to ban foreign purchasers. I am in favour of it, but I think you need to do that coupled with other moves because then, you might not have any housing whatsoever.
Well, I can say it's definitely allowed under EU law because in Hungary you're not allowed to own a company here if you're a non-resident. So if you ban people from owning a company, then you can certainly ban people from owning property.
Like there are no limits on foreign buyers.
Anytime anyone talks about that issue, they're just making stuff up. But
half of country homes, I believe, in Ireland were purchased by foreign buyers. It's crazy.
No, but anytime anyone says there's an EU regulation to prevent this, it's not true. It's 100% not true. I'd just say a couple of things about that. So first of all, from an economics point of view, I don't see any reason why there should be foreign investment in standard homes. Commercial property, maybe. I mean, because you need the commercial property to operate an office or anything like that. But why do we need foreign buyers in the home market? I don't. They're just rentiers. Like I don't know why you'd want that. My issue with it, though, is that the market's always going to figure out a way around it. So here in Hungary, you're not. People will catch me on the specifics of the law, but it goes something like this: if you're a non-resident, you have massive restrictions on owning a company here. I think you're actually not allowed to buy it. Maybe you are allowed to buy it, but you're locked in for 20 years on selling it. I can't remember the exact details. Massive restrictions. There are similar restrictions in Romania, but they're less onerous. But there are ways around it. You set up an LTD domestically, and you house the company under that. You can do that with property too. I'm not saying that's impossible, but what you set up is that the regulators are constantly chasing the investors. And the investors are massively financially incentivized to try and get into that market because no one else has got into the market. So in spirit, I'm very much in favor of it. In practice, I'm a little bit skeptical. The only way I can see to do that cleanly from an economic point of view is through real capital controls. But that would require capital controls on all assets. So that would mean that you'd prevent not just the investment in the house, but the investment in the LTD that you can set up to house the house. What that ultimately means is a return to something like the fixed exchange rate Bretton Woods system or something like that. Hungary is not going to get a say in that. That's going to be the decision of bigger powers if we want to go back to a fixed exchange rate system with capital controls in place. So I tend to lean on David's side of it. Beginning with mortgage subsidies, I'm very much so open to building public housing for families. I think that's a completely reasonable thing where you go and you build. We used to do it for people who couldn't afford it, and we'd hand them out. Maybe we should do that, maybe we shouldn't, that's not the debate here, but maybe you could just build that stuff and just cut the price and sell it to those families and let the central bank eat, some 30-year coupon loan that's never going to be paid off. Or something.
That's the Singapore model. That's what they do in Singapore.
Yeah,
it works well in Singapore.
Yeah,
we used to do it in Ireland.
That's the issue. Now, there are issues with that because you're sort of circumventing the problem, and as you go in that direction, your market interventions are going to get more and more extreme. But I just think trying to play the regulation game with Wall Street is like having worked there. You have to. It's a losing prospect. You've got the expensive lawyers on your side, and you've got the kind of regulators that are often easy to wine and dine, by the way. So there's plenty of ways to get around it.
Because in 2000s, I alluded to the special purpose vehicles. So again, a lot of these asset managers will set up an SPV to warehouse assets in Ireland. They declare themselves as charities. So they claim charitable status, which allows them to avoid VAT and capital gains. And that loophole was actually closed in 2016, but I suppose it was there for so long that allowed these private equity and private credit vehicles to run amok for so long. But again, when it was closed, a lot of these accounting firms were actually advising private equity, private credit vehicles on how to avoid it. So I suppose what the government has done is try to close some of these loopholes, but it hasn't really addressed the issue. So I suppose incentivizing the domestic banks to start lending again, coupled with a ban on foreign purchasers, I would be in favor, but just banning foreign purchasers without, getting the state back involved in the provision of public housing would be foolhardy, in my opinion.
I think do we have one more question? And then we're definitely up on time because we're already running over. Lots of excitement about housing. You've now learned how to get around housing regulations in Ireland.
A house for everyone in the audience.
It's been a very lucrative evening.
Thank you. So what will happen when the very large baby boomer generation starts to die over the next 10 years? So historically, I think what's happened, at least in this part of the world, is young people didn't buy or rent, they would inherit. But with this baby boomer generation, they've lived extremely long, but they are going to die, many of them, over the next 10 years. So what happens to the market when they all die?
Obviously, if you've got the population, you're going to see some very cheap houses. You see that all over southern Europe. There are many towns in Italy which have abandoned houses that are in reasonably good condition, and they'll give them to you for €1 if you simply maintain them. Live there for a few months a year. Same in Spain. A lot of modest towns and villages in the interior have simply lost their people, and housing prices have gone to next to zero. The desirable coastal cities like Barcelona continue to boom because there's a shift in population towards them. They've got a large foreign population, but yes, if our demographic winter proceeds and there are fewer people and fewer families, then ultimately housing prices in general will decline sharply and large numbers will be abandoned. In the city of Detroit, last I heard, there are 20,000 abandoned houses. So, yes, that can happen. The real estate market is very segmented depending on population and income trends in individual cities or individual neighborhoods in cities. You can get wildly disparate results, but your point is well taken globally.
I suppose you could see a further divide. I suppose people with wealthier parents, they could move into their house, and the people who don't have wealthier parents could be left out to dry. You could see a potential drop in house prices as well if they just, leave and it doesn't inherit to anyone else. So hard to know. I can't really look in a crystal ball and predict it. But I think it could lead to further divisions depending on who would benefit and who wouldn't.
Well, I just say really quickly before we wrap up, we have a real-world test of this. It's called Japan. Japan had a massive housing boom just before. It was not related, actually, but they had a massive housing boom that was related to various plaza accords and all stuff. We won't go into it. At the end of the 1980s, and at the very same time as their enormous housing bubble, I think it was the largest in history until the Irish one. When that collapsed, that was when they hit their boomer dying off moment, in a sense, right? Pretty much it overlapped. Not much relation between the two things. It was a complete coincidence. And they went from these insanely high house prices. Japan was probably the one to experience the dynamics that Theo's been talking about Ireland first. And then suddenly in the 90s and the 2000s, what David said happened. You can go now to, it's even worse than in Italy, you can go to Japanese villages that are overgrown, overrun. They have wildlife running through them. They're pretty much abandoned because the population's shrunk so much. But the issue is, as David said, that it's a little bit like the end of the Roman Empire. Everything concentrates back in. So if you go to Tokyo, it's still really expensive to get an apartment. In theory, house prices have come down when you take an average, right? But in Tokyo, it's still it's not as expensive, okay, as Boston or London or whatever, or Dublin. But it's still actually quite expensive. So the problem is that you just kind of give up territory. The hinterlands become like Detroit or like parts of southern Italy. So it's not... It's a little bit of a solution. If you have wealthy parents, as Theo said, you might be able to inherit a nice house in a city centre. But if you're living in a village and that village starts to die off and it becomes overrun by wildlife and plants, basically, go and Google this. By the way, it's fascinating pictures and videos you can find on YouTube. You don't get much out of it. So it just concentrates back in, and the rest of the country becomes a sort of desert, and there's no point in living in these places because, okay, you can go and live for zero money in an abandoned Japanese village, and it could be a really cool place to live, but, you'll be hunting for game and... like going down to the local river and getting buckets of water, I mean.
And again, there's a big cultural shift. People aren't getting married as they used to be, and people are opting for the single life, so there's no guarantee that they will inherit a lot of these homes, and so they could just opt for renting, and I don't know what they're going to do with these homes that were meant for families. So I think it speaks to a very cultural issue that we need to address. Housing is basically a microcosm, I believe, for a lot of social ills that policymakers don't really want to address. They just want to look at supply demand, and they don't really want to address the broader issue that we touched on throughout the evening.
Okay, well, we're 15 minutes over time, and I can see everyone wants to leave. No, you don't. It's been great. Thanks, everyone, for coming. I'd really like to thank our guest, David P. Goldman. That was fantastic. And Theo McDonald.